personally want to thank all of you for coming today. My name is Jared Kenney. I'm a wealth advisor and financial planner here at the Noble Group. And whether you're one of our participants in the many corporate 401ks that the Noble Group advises on, wealth management or financial planning client, we just really want to thank you again for being here with us. And we hope this is filled with information and even some motivation going forward. So first and foremost, we're not here to sell anything. We're just here to educate today. And so if you have any questions at the end, again, we'll be sending out emails where you guys can set times with us to answer any of these questions you may have. But again, this is really meant for high-level education. Each one of your situations is unique. We'll have a Q&A at the end, and you can enter in questions in the chat box, and we'll answer those at the end. But if you have something very super specific, I would just recommend scheduling some time and we can walk through that individually with you. Again, we'll send that out after the presentation. So let's review the agenda for today. The reason why we're doing life insurance is September is Life Insurance Awareness Month. And so we're going to review some facts and figures about life insurance because of that, because it's Life Insurance Awareness Month. We're going to learn into or go into how life insurance works, what it is, and why you might need a life insurance policy of some kind. Then we're going to break down the types of insurance, life insurance in particular, and then move into what we call a permanent policy as one of the types of insurance. After that, we'll kind of discuss three ways to utilize life insurance that with some of these little known benefits that some people may not know about. And then, of course, we'll end with Q&A and make sure we try to answer any questions that we can. All right, so let's review some facts and figures. So what we've noticed over kind of a long term are Americans are buying less life insurance than they were, 30, 40, 50 years ago. And we've seen this today, about 52% of U.S. households have individual coverage outside of employer coverage. As early as 2015, this was down to about 44%. So we've seen a little bit more of an uptick over the last 7, 8, 9 years, but it's still, if we look to the middle one, 42% of Americans say that they either need life insurance or more of it. And so there's a big insurance gap representing over 100 million adults. And if we look, 1/3 of Americans would feel the loss of the primary earner in the household within the first month, and another third would have no idea how to pay the expenses. So, and a primary reason for coverage outside of covering a wage earner or the breadwinner, however we want to say that, is to fund funeral burial costs or other end of life expenses. And then it wouldn't be any fun if we didn't have some good quotes in here, but fun is like life insurance. The older you get, the more it costs. And so we're going to walk through some of that today a little bit more because the younger you are, the cheaper the insurance is going to be. All right. So now we're kind of move into what life insurance is, how it works, and why we might need that. All right. So long ago, we figured out that there's strength in numbers. And so for hundreds of years, people have been joining forces against all kinds of calamities, not just life, but definitely financial troubles. And so at the end of life, if there's going to be financial troubles, the idea behind insurance is that if enough people pool their money together and form a large enough fund, then together we can handle basically any financial disasters, and get that death benefit coverage that we need. So the motivation for contributing to this type of fund or insurance is our own ability or eligibility to draw if that disaster, such as death, happens. So this is kind of a all for one for all, so to speak. So life insurance is really just a contract between the insurance company and you as the policy owner. The cost and availability of life insurance depends on factors such as your age, health, and type or amount of insurance you want to buy. We call this underwriting. So whenever you buy life insurance, you have to be underwritten. And that's just looking at those factors such as your age, your health, and a few other things in there. But as most financial decisions that we make, there are expenses associated with purchasing life insurance. We call those the premiums that we pay. Policies commonly have mortality and expense charges, amongst other things. And then also, if we buy into a policy and we want out, there could be potential surrender charges that can add to those costs, along with some income tax implications. So, any guarantees that the life insurance companies offer are based on the claims paying ability of that insurance company. So, just a few things to look out there for. But essentially, life insurance is a contract where we pay money in called premiums, and that gives us this benefit that if something happens to us, that our loved ones will be taken care of, or we can cover different reasons why we would get insurance. Okay. So again, when we look at the insurance company, there's three main parties to one of these contracts. First is the owner. So typically the owner is the insured. It doesn't always have to be that way. But if I wanted to buy a life insurance policy on myself to cover my wife and my kids in case something happened to me, I would be the owner, I'd be the insured, they would be the beneficiary. Primary beneficiary is who's going to get paid out first. If something happens to the primary beneficiary, we have a contingent. The contingent beneficiary would then get paid out if the primary beneficiary is no longer alive. Okay, so typically, what we see here for covering a wage earner is, let's just say a husband or a wife gets the coverage, the spouse is the primary, and the children are the contingents. That's the typical what we see. Okay. We call a question that we always ask is what is an insurable interest? Okay, an insurable interest is basically somebody that needs the coverage. So we have an interest in insuring them in case something happens. And the biggest example of this is the breadwinner or even a business owner insuring a key employee or future success of that company. So why would we want to buy life insurance? Right? Life insurance has three main uses. And so first, and the biggest one is income replacement. Again, in our earning years, when we have young children or wanting to start a family, there's things like expenses, the income that may need to be replaced. And we can either set people up, or spouses or significant others, whatever that is. We can set them up to have the same lifestyle, a different lifestyle, a better lifestyle. We have those choices in there. But inheritance. So a lot of times we want to leave a specific gift to our children or grandchildren or anything there. Life insurance can hit that where we know exactly what's going to go from there. And estate taxes. Not most Americans aren't going to have to worry about estate taxes anytime in the near future. Now we're going to talk about this a little deeper later on, but there are ways for life insurance to cover potential estate taxes down the road. And this is specific to federal. Some of you do live in states outside of Texas, like where we're at, where there are no state estate tax or inheritance tax. Your state may have those. And so the life insurance can bridge that gap for those as well. Just be careful. I always like to recommend this. Just be careful when you're buying life insurance because there are insurance agents out there that it's the only arrow in their quiver and they sell life insurance and that's it. They make commissions on those. And so you just got to be careful to make sure that you get the right policy for the right reason that you need it. Yeah. Okay, so those are kind of why we would buy insurance and how it works. So let's kind of look at the different types of insurance, life insurance that are out there. Okay, so there's two main types of life insurance, term and permanent. And just like they sound, term is a temporary solution to what could be a permanent problem. Permanent is coverage that's going to be there for a while. So when we look at this here, an overview of term life insurance is it's a temporary coverage. Okay, so we choose a term, typically a 10, 20, 30-year type term, and we pay a premium for that. Okay, gives us a benefit amount, but we don't gain any cash value. It's just there for pure benefit amount. Permanent policy is a little bit different. The premiums tend to be a little bit higher. We get coverage for a lifetime, and that can last all the way up to 121, 100. We can kind of pick these from time to time. So, but costs again will be a little bit higher, but we accumulate a cash value. So it does kind of have a savings component with it. Many different ways to do this. So term insurance, when we look at that a little bit deeper, the reason why we would buy is because it's simple and affordable. It's a way we can protect our family financially in case of an untimely death. Policy pays out the death benefit to beneficiaries We set that term again, 10, 20, 30 years or anything in between. And that's usually when your income is the most critical to your dependents. So we want to make sure that if we get some type of coverage, if something happens to you, term is by far the simplest and easiest way to do it. Okay? And it can help cover things like debts, fund expenses, or continue to live the same lifestyle or better lifestyle that we were before. So some pros of term life insurance are lower premiums compared to permanent. Okay, provide coverage during those critical years that we need it when we're earning our money and saving. Okay, it's very simple and easy to understand. We pay a premium, we get a death benefit, and that's pretty much it. Some of the considerations with it are there are no cash value. So you're putting money into this and it's just getting your pure life insurance coverage. You're paying for that risk replacement. Okay. And then the coverage ends after a set term. Term insurance usually allows for a conversion to permanent, but then you pay those higher premiums on the permanent and an older age. So there are considerations to make when we buy term, but if it's all we can afford or it's all we need in that moment, term is a wonderful thing to have. So now let's dive in a little bit deeper to some permanent life insurance policies. Okay, so these are things that some of you may know what these, some of you may never heard of these, but there's really two main types of permanent policies: whole life and universal life. Okay, universal life has three main different types that we utilize, and whole life has two, which we're going to get into in a little bit. But whole life basically offers a set death benefit along with that savings account. You have a fixed premium that you pay for either life or for a certain period of time, and you're guaranteed to have that death benefit. And there's a cash value growth component based on the dividends paying ability of the insurance company. Okay. Universal life is a little bit different. It offers a guaranteed minimum death benefit as long as you pay your premiums to cover it, but you have the flexibility to change your premiums um, over time. So you can pay a little less based on if you financially can't afford to pay into that anymore, you can drop and raise the death benefits there. Okay. Variable life insurance is the same thing as universal life. The only difference is it's tied to what we call sub accounts or essentially mutual funds inside the policy. So it offers a variable death benefit. It can move if you want it to. And you can also adjust those premiums based on your financial conditions at the time. But it does offer a little bit more risk because it is tied to the stock market growth or decline. So, and you get to pick what you invest in, stocks, bonds, anything there. Okay. Index universal life is a kind of a mix between variable and regular universal, which just gets a guaranteed minimum or a guaranteed rate from the insurance company. It offers that same variable death benefit. We can move it up and down. We can start it low, raise it high. But it also offers those adjustable premium payments like all universal life does. But the rates that are credited to it are linked to an external index, such as the S&P 500, but also offers downside protection via a guaranteed minimum interest rate. Okay. To get that guarantee, that downside protection, typically somewhere between 0 and 2%, there is a cap on the gains. So the biggest difference between the index and the variable is they're both tied to the market, but in the variable, you're actually invested in the market, or in the index, you're actually just kind of linked to that index. Okay? But the biggest difference between these four types of permanent policies is just the way they credit interest. That is pretty much the biggest one. And we're going to look at this a little bit deeper. For the instances of this presentation, we're going to look at whole life and we're going to look at variable and index. We're not going to look at universal life right now. That's a very specific thing that we typically don't utilize a lot anymore these days. Okay. So let's look a little bit deeper at whole life. Okay. So there are two main types of whole life insurance: participating and non-participating. In a participating whole life insurance policy, the policyholder is eligible to receive those dividends from the insurance company. And these dividends are typically paid out annually and are based on the company's financial performance, just like it would be in a stock. Okay. It includes, we can put it into the investment returns of the company, and the claims experience is what creates those profits where they pay those dividends. Okay. You can use the dividends as a policyholder in various different ways, such as reducing future premiums, increasing the cash value, purchasing additional coverage, or just receiving them in cash. Okay. There is a potential to earn dividends that can increase the policy value or reduce costs but the dividends are not guaranteed and depend on the insurer's performance. It's very important to understand that. In non-participating whole life, it's more predictable and straightforward with guaranteed benefits, but there's no dividends. Okay, so basically, you participate in the profits of the company. In non-participating, you do not. So it does offer a little bit lower cash value growth potential, but there is typically a cost reduction for that guaranteed death benefit as well. Okay, so whole life insurance provides coverage for the policyholder's entire life. So when we look at the pros and considerations of a whole life policy, the guaranteed death benefit is there as long as you continue to pay the premiums. So it also has a cash value component that grows at a fixed rate, typically guaranteed by the insurance company. Policyholders pay consistent premiums, part of which fund the death benefit, while the remainder contributes to the cash value. Over time, that cash value accumulates tax deferred and can be accessed via loans or withdrawals, depending on how the tax efficiency of that we need that to be. The policy is credited through fixed interest payments determined by the insurer, which guarantees a minimum rate of return. Some whole life policies may also earn the dividends. Those are the participating policies from the insurance company, which can be used to increase the cash value, again, reduce coverage, reduce premiums or purchase additional coverage. Okay. So big thing here too, with whole life insurance, we seem to have a little bit higher premiums because we are investing that money as well. We're not just paying for insurance coverage. So it's going to be more expensive than term. There is a complexity to it. It's not that complex, but it is more complex than term. And there is some inflexibility raising without putting money in and raising death benefits and things. So there are some definitely some considerations with whole life. All right. So variable universal life. Again, this is just a universal life, a permanent policy, adjustable premiums, adjustable death benefit that's tied to the market. Okay. So it allows for flexibility of those premium payments while also being able to increase or decrease that death benefit based on your financial situation. We can allocate the cash value to a range of investment sub-accounts, again, basically mutual funds, such as that invest in things like stocks and bonds, offering the potential for higher returns compared to whole life or standard universal life insurance policies. So essentially, the variable insurance ties your cash value growth to market returns, which also brings in a level of investment risk in the policy. There's a risk of losing value if the investments perform poorly. Okay. VUL policies tend to have higher fees, including management fees for the investment sub-accounts, administrative costs, insurance charges, which can tend to eat into returns from time to time, if not doing well. So they bring with them a level of complexity with the investment options, fees, and potential risks, which require financial knowledge and a good advisor to help manage. If investment sub-accounts aren't managed properly, growth can become inconsistent, whether it be from volatility of the markets or even poor investment decisions. So VULs carry a little bit more risk than the whole life because of the market return potential or decline potential, depending on how we're investing that. All right. With index universal life, this is a little bit different. The cash value grows based on the performance of the stock market index, again, such as the S&P 500, offering higher potential growth compared to fixed rate policies like whole life and standard universal life, but without the direct market risk due to the downside protection offered with the minimum guaranteed interest rates. This ensures that the cash value won't lose value even if the market performs poorly. Like all UL policies, the flexibility of premium allows for changes dependent on your financial situation, tax-deferred growth of the cash value, which allows for more efficient accumulation over time. And policyholders can choose between different index options and allocations based on their risk tolerance, growth expectations, and desire to have that policy continue to grow. Okay. So like VULs, IULs tend to be a little bit more complex due to caps on the growth. So the cap on the growth from a IUL basically says, because we have that downside protection, we're also going to limit the growth. And this looks different across all insurance companies. It's hard to put one in just as it says, but typical is we see a 0% floor, meaning that we can't lose if the market goes negative. And we'll see caps somewhere in the 8 to 12% range. So still can perform pretty well over time, but getting that downside protection does limit the upside potential. Okay? So, but they can be a little bit more complex because there's also rates that we participate in the growth of those indexes. There's an interplay between the premiums and the cash value component. So, but again, due to that downside, the cap also plays in, just making this a little bit more complicated. But also, if we have the right policy and the right fit, this is what a good advisor will help you manage through time. Um, Another side of this is, even though we're linked to the market, we don't grow with the market from a dividend perspective. So like a VUL would accumulate the dividends inside of the mutual funds and the stocks and the bonds that they invest in. We're just tied to that index. And so we don't directly participate with those dividends in an IUL. Mhm. Okay, so those are the main types of permanent policies. Okay, so we've got whole life, universal life, variable universal life, and index universal life. They all have a place. They all have a way to do it. And then all of them offer some bit of how we can use these and unlock the power of some of the things inside these policies. And so we're going to walk through this a little bit here. Um, so when we talk about extra benefits of life insurance, there's many, many ways. Picking just three was very difficult to do. We could sit on this for hours and hours and really go through all the benefits that life insurance can provide. But I picked three main ones because to me, they're very important reasons why we would need to get coverage. Okay. First one is living benefits. Everyone associates life insurance with a death benefit. That's the benefit that pays out at the end of life if we have the life insurance policy in place. Living benefits, this is a fairly newer thing with life insurance, probably over the last decade or so, but they provide benefits, basically access to the death benefit while you're living for things like chronic illness, think of long-term care there, critical, think of having a heart attack and being stuck in the hospital, and terminal benefits. Basically, you have 12 to 24 months left to live. You're able to go access that death benefit early. Okay, and we're going to walk through that a little bit deeper here. Wealth transfer and estate planning, right? As you get older, and if you have an estate, whether you're in the estate tax exemption or outside of it, it's a very efficient way to transfer wealth down to the next generation or even two generations down. So we're going to look at a good way to utilize that there. Tax-free income. Anybody that sat on our last tax webinar, we went through this kind of what's called a life insurance retirement plan. We walked through that a little bit. We're going to go through that a little bit deeper today, utilizing life insurance to create a tax-free retirement income in the future. Okay. So let's start with living benefits. Chronic, terminal, critical illness, they're riders that are on universal life policies, and they provide these crucial benefits that can enhance financial security during challenging times. Okay. So even some term policies offer these nowadays. So it's just going to depend on what we're looking at. Okay. So let's take a deeper look at each one of these. Okay. So a chronic illness rider allows access to a portion of your death benefit if you're diagnosed with a chronic illness that requires assistance with daily activities. The funds can be used for various expenses such as long-term care or medical bills, providing really that essential support during those challenging times. This flexibility allows you to manage your care and related costs without restrictions on how that money is spent. So we call them indemnity programs, basically meaning you get a check and you can kind of spend it however you want. Okay. A terminal illness rider, similar except for covers if you've been diagnosed with a terminal illness, typically defined as having a life expectancy of 12 to 24 months or less. Okay, and that's dependent on each insurance company. The early payout can help cover medical expenses, hospice care, alleviating financial burdens on your loved ones, but it also provides the opportunity to make choices about your care in your final days, enhancing the quality of life during that potential difficult time. Okay. And a critical illness rider basically allows you access to a portion of that death benefit if you're diagnosed with a serious illness such as cancer, heart attack, or even like a stroke. A payout provides flexible financial support for medical treatments, living expenses, kind of helping you preserve your other savings if that's a necessary thing to do. But ultimately, it offers peace of mind. All of these offer peace of mind, allowing you to focus on recovery without the burden of financial stress. One thing that will clearly define here is when somebody passes away with a life insurance policy, those benefits are tax-free to the beneficiaries. Okay, it's income tax-free to the beneficiaries. Okay, when we access these living benefits early, we get a portion of that death benefit early. Those are also tax-free. Okay, so we can go get those dollars early. Okay? Most of these riders come with no cost. Some, depending on the insurance company, some have a little cost, but most of these riders have no cost. So they're just part of that policy pricing already. And so it's just an early access. If we had a $500,000 death benefit and we wanted to go get 20,000 to help cover some medical bills due to a critical illness, we're able to go get that 20,000 tax free. There's no going to be no tax with that. So it's a way to say we have this problem when we want to cover our life in case something happens to me, but we can also kind of kill two birds with one stone at that same time and have these living benefits to help cover things like long-term care if we become terminally ill, or we have one of those critical illnesses such as a heart attack or stroke in there. You know? Okay. We're going to move on to wealth transfer and estate planning. This is something that's very big for me because we see so many of our prospects coming in, potential clients, and when they're coming in, we see not a lot of estate planning has been done. Okay, we'll be doing estate planning webinars down the road, probably towards the beginning of the year next year, which are really good. So, what we want to talk about here is something that is important to me from a standpoint of people that want to leave an inheritance, people that want to make sure that their family is set up or pass down the wealth that they've generated through their life in a very efficient way. And so back in 2017, starting in 2018, the Tax Cuts and Jobs Act introduced a substantial increase in the lifetime estate and gift tax exemption. Okay. So currently individuals can shield up to 13.61 million from their estate tax and gift tax, while married couples enjoy over 27 million. Okay. Now, at the end of 2025, all of this, the Tax Cut and Jobs Act sunsets, meaning that in 2026, we revert back to what it was in 2017, which is essentially going to cut these things in half, if not more. Now, again, the majority of Americans still are not going to be in a wealth bracket to pay estate taxes federally. Again, state by state is going to be different than that. Okay. But without any legislative action, we know this is going to happen, right? We know that it's going to move from what it is currently down to more. And the prediction is about a $7 million estate tax exemption for individuals and close to 14 for married couples. Okay. Now, while that might sound like a ton for most of you, and maybe we don't have to worry about that down the road, just 20 years ago, the state tax exemption was $1 million with a top tax rate of 49%. So nothing that says legislatively that we can't move to this. So what does this mean for us? Well, when we look at these charts here, if somebody were to pass away today with $10 million, they would owe nothing in estate taxes. Okay. If they pass away in 2026, they're going to owe 1.2 million in estate taxes. That's a huge swing for any of those people. How do we pay for that 1.2? If we're business owners, or we've got farmland, or we've got assets we don't want to liquidate, where's this money going to come from? And the answer is life insurance. Right? We can fund a life insurance policy to cover these estate taxes in a tax-free manner. Okay, so we just want to look at these planning strategies here. And this is one of many ways to utilize life insurance in an estate planning realm. But this is one way that we look at this. Okay. This is called an ILIT, or an irrevocable life insurance trust. Okay. We set up the trust. We put the asset of the trust is the life insurance policy. We make contributions to the trust, which pays the premiums for the life insurance policy. Upon death, all of those assets in the life insurance policy, the tax-free death benefit, are free from the estate. So life insurance is income tax-free when we receive it, but it's always a part of your estate, meaning that it could be subject to estate taxes. So in here, we use these trusts to put the life insurance policy inside the trust, and then upon death, the death benefit pays to the trust, and then the trust pays out to the beneficiaries. And then it's an irrevocable trust. There's many mechanisms that go along with it, but we utilize these a lot to transfer that wealth free of income tax, estate tax, and also it's in a trust, so it's going to not go through probate. So it's not going to be public. So there's going to be some privacy with that, which is very important for a lot of people. So utilizing this is, again, one strategy for wealth transfer, but utilizing things like this as we get older and we have the goals of transferring wealth, not paying estate taxes, whatever those may be, this is one vehicle that we can utilize to do that. Okay. So if you guys haven't figured out, we've been doing these or I've been doing these webinars with you guys for about 6 months now, and I'm a very big tax planner. So one thing that we would like to look at is how can we create a very tax efficient retirement portfolio, retirement income stream? How can we do those things? Okay, so whether you're 25, 40, or 60, these are things that can really work for you. Okay, these are things that we can still set up. It's usually not too late, but we want to use this. So one thing that we utilize life insurance for is what we call a life insurance retirement plan. Some of you may know these. It's life insurance retirement plan, be your own banker. There's many different marketing names for these, but it's basically utilizing the power of either a whole life, a variable life, or an index universal life, utilizing the benefits of those to create these very tax favorable income streams or ways to go get money and spend it on things without really even having to pay back the interest, or you can. There's many different ways to do this. So a life insurance retirement plan is simply a strategy using a permanent life insurance policy that provides us both a death benefit, but then also income from our cash value via policy loans. Okay. So a life insurance retirement plan is just a strategy that we utilize for both tax deferred growth. So the cash value that grows in these life insurance policies is tax deferred. Okay. So if we wanted to cancel the policy and take it out, any gain on that's going to be taxable. Okay. But when we look at these from a tax-free withdrawal, what we do is we take a policy loan from our life insurance policy, and that is a tax-free income stream. Okay. So we can do these over time. I'm going to show you some examples here. But we take that out and it just provides that tax efficient income. The great thing with this is they can be stopped, they can be started, they can kind of go whenever we want them to go. Unlike IRAs, Roth IRAs for retirement, you have to be 59 and a half to get those from an income stream without penalty, minus a few caveats. In these life insurance policies, there is no age minimum or maximum. You can take the money out whenever you want, however you want. Okay, so you can take some, you can take less the next year. It can go. It's very, very adjustable, very flexible. Okay. But the biggest thing with this too is it provides a death benefit. Okay, so the death benefit that comes along with it, we're going to be, if we invest, $20,000 a year into our 401k, if we pass, what the value of the 401k is what our beneficiaries get. With life insurance, when we invest $20,000 a year into it, we get a death benefit that's much higher. So if something happens to us along the way, we know that death benefit's going to come down tax-free to our beneficiaries without any tax implications to them. Okay. So, but basically, who would benefit from a LRP is anybody that is looking for both death benefit coverage and a way to grow and diversify their income streams in retirement. Okay. Or even be able to, you can use these for college planning. You can use these for buying homes. You're going to use these for a lot of different factors. So each specific person is going to have a different way to look at that. Okay. Creditor protection. This is really big. Texas is a big state for this. So anybody, we've got people in South Carolina, North Carolina, all over. Each state by state creditor protection is a little different. Typically, in most states, life insurance is creditor protected. So any monies we put into this is really big. We use this a lot for doctors, vets, anybody that could be, potentially sued for what they're doing. We can put these monies into this life insurance policy, thus shielding those from potential creditors at some point in the future. And so then we grow and we get all the benefits of that. Hey, we talked about living benefits earlier. These things do offer those living benefits as well. Okay, so let's kind of take a look at this. Anybody that was on that last tax webinar, this is going to be this the same two slides, kind of the point of this. Um, but we're going to take a 45-year-old. Again, these things work really well for anybody, that has an income that's over the age of 18 that can fund these things. The longer we fund them, typically the better, the less we have to put in, and the better from a compound interest standpoint. But these things work all the way up to about age 60, where we can still utilize them going forward. So in this example, we're going to take a 45-year-old. We're going to put in $1,000 a month or $12,000 a year. And what we see here is you're going to see it starts with an initial death benefit. We're going to kind of compare whole life. Sorry about that. We're going to compare whole life and index universal life and kind of the difference here. So you can see here with whole life, this is a big thing. So whole life, when we pay in, we get a set death benefit. It's guaranteed. It's going to be there. As the cash value grows, we can also purchase more insurance. So you can see the insurance is going up. On the index universal life, in these type of plans, typically we want to lower that death benefit as low as possible so we can max fund it, basically meaning the policy costs and everything are low. And so what that does is it drives the cash value growth. If we look here in year 10, you can see this difference here. We're putting the same amount of money, but yeah, we have over $20,000 more of cash value growth because the cost of insurance is going to be less because we have less death benefit than over here, right? So we fund this for a period of time, and then we'll move on to the income side. Okay, let's say we want to, at 66, we want to start taking income from these policies. Okay, in this example, we did this for 20 years. Okay, so in a whole life policy, again, death benefit's going to be higher, thus the cost of insurance is going to be higher. And so our income that can we generate from that is going to be a little bit lower. Okay, the whole life comes with the guarantees. We know it's going to be there as long as we continue to pay that premium. Index universal life, again, what we've done is we've lowered that death benefit as far as the IRS will let us do to keep all these tax benefits in here. And thus, because we're paying those lower costs, we get a greater cash value growth. Thus, we can get more income out of here. So this is how these things work, is essentially we fund these for a while. Most of the time, if we're 45, we're going to try to fund those for at least 15 or 20 years. And then we'll wait a little bit, at least a year usually, and then we can start taking income. For those that are younger, if you're 25 and we can afford to put in $500 a month into something like this to save for retirement, we'll do that up until, maybe for 30 years, and we'll fund that whole policy and then wait 5 years. And at 60, we're going to have this gigantic tax-free income benefit in the future. Right? So now with these life insurance retirement plans, there's always consideration. Anything we do financially is always going to have a benefit, but it's always going to have considerations that we have to look at. So what are the considerations for a life insurance retirement? Cost is big. So permanent life insurance policies are just more expensive than term because we're structuring for that cash value accumulation. We call it overfunding, but it's basically we're funding it to the max that the IRS allows us to do it while keeping all the tax efficient benefit nature of it. Okay. And complexity. Okay. Life insurance retirement plan can be complex. Careful management. We have to manage that index year over year. And we want to make sure that the policy doesn't lapse because we took out too much money. Luckily today, most of these life insurance policies come with what's called an overloan protection rider. Really, really good. Essentially saying that you can't take too much money out and have the policy lapse, which is good because if that happens and you have taken loans from it, there's going to be a big tax impact there. So from a return standpoint, depending on the policy, if we're using, whole life or an index universal life, which are the two main to do this with, the growth of that cash value is going to be dependent on either the market or the dividends that are being paid from the whole life insurance company. Okay, so the returns are something to always think there where we could project this out over a long term, but they could be less, could be more, but could be less. Okay. Policy loans, another part here. The loans will reduce that death benefit. As we saw in here, we can see as we take loans out of the policy here, it's going to reduce that death benefit because in this instance, we're not paying back the loan. The loan is being paid out of the death benefit. So when you do pass, the death benefit, the very far right-hand column here is really what we call the net death benefit. It's the benefit after we pay back the loan. Okay. So if those aren't carefully managed, we can really drop that death benefit down too quickly. There's no like amount you can or can't take. They're set based on not taking too much of the cash value out at one time. But there could be some taxes and penalties if some of that happens. So it's just we need to carefully manage that, which is fairly easy to do if you've got a good, competent advisor or insurance agent that's going to stick with you through those years. Okay. And last, like any life insurance policy is underwriting. Again, age, health, all that is going to factor in. And so if somebody's not very healthy and they're really old, these type of policies just aren't going to be there. They're just not going to work very well because the cost of them are going to be too high to get that coverage, and thus that cash value is not going to grow very well. So underwriting is a big consideration. If you're younger and you're healthier, these things are wonderful. If you're even a little bit older in your 50s and you're in really good health, these things can be really, really good as a way um, to create a retirement income stream that goes along with 401k, brokerage accounts, anything there. Okay. Okay, so moving on here, we want to talk about some action items, right? So very important to us isn't just the education, it's about taking action, right? We can put a big plan together, but if we don't implement it, we haven't taken action and there's really no point to have the financial plan. So action items for anybody on here today is just learn about your coverages. You may have life insurance through your employer. One thing with employer life insurance is typically it's not portable. So if you leave that company, the new company you go to, I hope they have life insurance coverage there. Okay, so having outside coverage, just learn about those, what you have from your employer, what you have individually, and get a review of it. Okay, we're here to help with that and do that. Understand your budget. Life insurance retirement plan is a great thing to do, but if you can't afford to put enough money into it, it's probably not going to be worth it for you. Okay, so just look at those income and expenses and just make sure you got those covered. Okay, term is a very, very, very cheap way to get insurance coverage. For a 35-year-old male at $1 million, you're probably looking at $25 a month. So it's very, very low from a cost standpoint. Okay. And then just like that, determine your need. Okay. Very important is we see a lot of underinsured and a lot of overinsured people. So determining what your need is typically done inside of a financial plan, but we can also do it. There's some calculations that we can do to kind of get there if we're not at an age to really have a full financial plan yet. So, and then risk, again, we've got term, we've got three different main ways to get permanent policies between whole life, variable, universal, um, or excuse me, index. So prioritize that risk. What is your risk? Do we need coverage? Do we not need coverage? If you don't have coverage, I would say look at it. Let's have a conversation with somebody, whether you have an insurance agent already or you want to use the Noble Group and our complimentary services that we offer there, and then put a plan together, right? Talk with your spouse if you have one. If you have children, you should be covered. These are all things that we preach and preach and preach in our planning. So those are some action items for you to take away today. Okay. When we talk about insurance reviews, real important here. Life insurance is a key thing, but we should be reviewing our insurance coverages at least every other year, if not every year. Okay, so when we look at this, we help review the policy and then we decide, okay, so protect, we have a family. We want to make sure that the income that we're making can continue on for our family if something happens to us. Okay, enhance are things like a life insurance retirement plan. Okay, how do we make sure that we're going to use this money we're putting into this life insurance policy? How is this going to help us for retirement, not just from a death benefit standpoint? Okay. Longevity. These are things like our long-term care riders, our chronic, critical. These are all things that just help make sure that money's there to help make sure that we don't erode our retirement savings if something like that happens. And then legacy, that wealth transfer. Okay. These are big things for a lot of people. We have people that come in and say, I don't care what my kids get. I worked my whole life for this. They'll get whatever's left over. And then we have others that have specific things that they want to have happen. Everybody's unique. Everyone's different. But it's just making sure that we cover everything. A big saying that we have here is we want to make sure that we take a look at it now so that 10 years from now, we don't look back and say, I wish we would have done that. Okay? Our job is to make sure that we take a look at that over time. So insurance reviews, again, whether it's life insurance, property casualty, disability, long-term care, those are all real important to take a look at. Okay. All right. So now we're going to get into some next steps and questions. And as we start that, just as an overall financial planning piece, at the Noble Group, we help do this. So if you have questions, and again, a lot of this is complimentary that we do as being a part of our 401k groups, just give us a call. Again, I'll send you guys a calendar link to schedule on my calendar if you have questions you want to talk. But just making sure that we put these plans in place and that you're covered and you know why. Okay. Okay, so let's get to some questions here. Okay. All right, so first question is, can inheritance be set up as payments into a family trust? Is there a benefit to creating a trust over making direct payments to individuals or children? Great question. Yes. Yes is both of those. Inheritance can be set up to put payments into a family trust. There's many different ways to do this. It depends on, there's a lot of times there's people that are charitably inclined, and there's different trusts we can use for that, or donor advised funds. Anybody that was on that webinar last month, we talked about donor advised funds a little deeper. But yeah, so you can have the family trust created inside of a will, what we call testamentary trust. There's many different ways to do that. I would recommend, if you have an advisor already, I'd recommend talking with them. If not, give us a call. We can help kind of navigate that a little deeper. Okay, next question. Oh, when we went through the life insurance retirement plan, I assume this is what the question is the income tax-free in this example? Yes. So when we look at these values here, the income, for the IUL side, let's say it's 33,293. That is a policy loan, aka tax-free to you. So that is the tax-free amount. It doesn't get reported on your income tax return. It's similar to getting money out of a Roth. Okay? It just comes straight out to you. It's a loan, so there's no tax impact there. Okay. Next question is, I'm 58 years old. Will a life insurance retirement plan work for me? The answer is potentially, yeah, absolutely. Typically, when we get a little older, we fund it with higher amounts for shorter period of time, but it'll really come down to, again, underwriting, age, health, what we're looking at, and then also your goals. What are our goals? Is our goal to have life insurance coverage to make sure that our spouse or beneficiaries are set up? Do we want to diversify our income streams because we have 401ks, we've got brokerage accounts, maybe we have some Roth, but we want to create some more tax efficient income? Those are all goals that we would have to align to make sure that that's even a right thing for you to do. Okay. But yes, it basically, for the most part, once you start getting around 60, 61, 62, it starts to not make as much sense unless we want income for the back end, which is, again, something, if you're that age and you're interested, just schedule some time. We'll walk through that. Okay, one last question here. So yes, I'll be sending out, when we send out the recording, I'll also be sending out the slides as well. So you guys will get copies of that. Typically, we do have a compliance protocol we have to go through to get the recording approved to send out. So that's typically a couple, 2 to 3 days. And so when we get that, I'll send all that out to you guys as well. So that's it. So I guess that's it from a question standpoint, guys. Well, thank you all so much for being here with us. Our next webinar will be either towards the end of October or the beginning of November. Stay tuned for that. We may be doing something around the election. We're still kind of coming up with what we're going to be doing for next month. So, but I appreciate everyone being here with us today, and we will look forward to seeing you all in the next month. Again, we'll send all that stuff out. Schedule some time with us if you have any questions to your unique situation. Have a great day. Everyone have a good one. Thank you so much.